Gold pays no interest, no dividend, no rent. It doesn't produce earnings. A gold bar can sit inside a vault for 50 years, and at the end of those 50 years, it's still just a gold bar. So by the normal rules of investing, this should be a terrible asset. But in the second quarter of 2026, central banks bought roughly 289 tons of it. At the same time, investors were pulling gold out of ETFs. Same metal, one group selling, another group buying aggressively. So why would some of the most conservative financial institutions on earth keep buying an asset that promises to pay them nothing? Because central banks are not buying gold for the reason most investors think they are. Let's follow one bar. Start with something easier to value. Buy a stock, and you're buying a claim on a business. That business can sell products, generate profits, and return some of those profits to shareholders, so analysts can estimate what those future cash flows might be worth today. A bond is different, but the logic is similar. You lend money, someone promises interest, and eventually they promise to return the principal. Gold makes no such promise. Put a gold bar in a vault. Come back tomorrow. Still one bar. Come back next year. Still one bar. There is no factory inside it, no tenant, no coupon payment, no quarterly earnings call, which creates a strange problem. If gold doesn't generate cash, what exactly are you valuing? A stock can become cheap relative to its profits. A bond can become cheap relative to the payments it promises. But gold has no income stream to anchor it. Its market value depends heavily on what somebody else is willing to pay for the same metal later. That sounds speculative, and sometimes it is. But there's another reason somebody might pay. They may not be trying to make money from the gold. They may be trying to protect money from something else, and that changes the entire story. Imagine one gold bar on a table. 4 buyers walk toward it: a jeweler, an investor, a central bank, and someone frightened by a financial crisis. They're all buying gold. But they're buying 4 completely different things. For jewelry buyers, gold is a consumer product. Price matters enormously. When gold becomes very expensive, necklaces don't suddenly become more useful. So demand can fall. And that's exactly what happened in 2026. High prices pushed global jewelry consumption sharply lower. For this buyer, higher prices can destroy demand. James, the investor, may never touch a bar. He may simply want exposure to the gold price. If the dollar weakens, real rates fall, or fear rises, gold may become more attractive. But if interest rates rise, or another asset suddenly looks better, he can press one button and leave. And in the second quarter of 2026, global gold ETFs lost roughly 45 tons. For this buyer, gold competes with other investments every day. Now look at the central bank. It isn't saving for retirement. It isn't trying to beat the S&P 500. It isn't buying a wedding necklace. Its job is to manage national reserves, which means its priorities are different: safety, liquidity, diversification, and the ability to survive events most investors hope never happen. That's why comparing a central bank's gold purchase with your own portfolio can be dangerously misleading. You're solving different problems. Take a government bond. Someone owes you money. Take a bank deposit. A bank owes you money. Take corporate debt. A company owes you money. Gold is unusual. No company has to remain profitable for the bar to exist. No government has to make an interest payment. No borrower has to repay it. A physical bar sitting inside your vault doesn't have an issuer. That is normally gold's weakness. It doesn't promise you income, but in a crisis, the same weakness becomes interesting, because something that promises nothing also cannot fail to make the payment it never promised. This is one reason gold has a role inside reserves, not because it is guaranteed to rise. It isn't, but because its risk is different from a bond, a currency deposit, or another financial claim. Central banks have told us what they care about. In the 2026 World Gold Council survey, 90% of responding reserve managers said gold's performance during crises was relevant to holding it. 84% pointed to its role as a long-term store of value. More than 80% highlighted diversification, and 89% expected global central bank gold reserves to increase over the next 12 months. They aren't secretly telling us gold can only go up. They're telling us what problem they're trying to solve. Most international reserves are financial claims, currencies, government bonds, deposits. They work extraordinarily well until the risk you're worried about is connected to the financial system itself. Currency risk, interest rate risk, political risk, sanctions risk, or simply having too much national wealth tied to one issuer or one currency. Gold offers another bucket. Not a perfect bucket, just a different one. Here's where many gold videos become misleading. They say, gold is a safe haven, and viewers hear, gold is safe. Those are not the same thing. In January 2026, gold reached a record near $5,600 per ounce. Then it fell roughly 20% from that peak. A safe haven had just produced the kind of drawdown that would terrify many people who bought it because they wanted safety. So what happened? Remember, gold pays no interest. If safe government debt suddenly offers attractive real returns, holding a metal that pays nothing becomes more expensive in opportunity cost terms. This is why interest rate expectations matter so much. When markets begin expecting higher real rates, gold can lose some appeal. Even if nobody has discovered a new gold mine, the dollar matters too. Gold is globally priced in dollars. When the dollar becomes stronger, gold becomes more expensive for many non-dollar buyers. When the dollar weakens, the opposite can happen. So sometimes gold is moving, not because the metal changed, but because the measuring stick did. And then there's sentiment. During a crisis, investors rush toward protection. When fear fades, some of that money leaves. This can happen far faster than mines can change production, which is why gold sometimes behaves less like a normal commodity and more like a global vote on uncertainty. Gold has thousands of years of history, but gold buyers still have very modern brains. When price breaks a record, news coverage increases. Searches increase. Friends talk about it. Videos appear telling people why the rally is only beginning. A higher price can attract more buyers precisely because the price is higher. FOMO works in gold too. Gold rose dramatically in 2025. Then it entered 2026 with enormous momentum. It passed $5,000 for the first time. Retail attention surged. Investment demand surged. Forecasts became more aggressive. And for a while, rising prices helped create the story that justified more rising prices. But feedback loops work in both directions. Imagine buying physical gold near a peak because everyone around you is calling it a safe store of value. Then the price falls 20%. The bar in your hand hasn't changed. But emotionally, the problem has changed completely. Yesterday you were worried about inflation. Today you're worried about the price of your supposedly safe asset. That's the gap between understanding the job of an asset and simply chasing it because it recently worked. If you decide you want exposure to gold, another argument begins. Physical bar? Coin? ETF? People often argue as though one is universally superior. It isn't, because again, they're solving different problems. A gold ETF solves convenience. It can be bought and sold like a security. No safe in your house, no need to physically transport kilograms of metal. No need to find a dealer every time you want to trade. For someone who wants liquid portfolio exposure to the gold price, that's useful. Physical gold solves a different problem. You can actually possess the asset. That removes some layers of financial intermediation, but it creates new problems: storage, insurance, theft, verification, dealer premiums, selling friction. Physical ownership removes one kind of risk by accepting another. This is why the argument never ends. The investor saying, "Why would I want a heavy metal in my house?" may be completely rational. The investor saying, "If the financial system is what I'm trying to hedge, why would I own only a financial claim?" may also be rational. They're not necessarily disagreeing about gold. They're disagreeing about the disaster they're preparing for. This might be the most important point in the video. When a central bank buys gold, that does not automatically mean you should. A reserve manager may be trying to reduce geopolitical concentration. You may be trying to fund retirement. Those are different objectives. A central bank can tolerate an asset that pays no yield because maximum return is not its only goal. For many households, return matters much more. Think of insurance. You don't buy home insurance because you expect it to outperform the stock market. If your house never burns down, the insurance can still have performed its function. Part of central bank gold ownership works in a similar way. The cost is opportunity cost. The benefit appears most clearly when other parts of the financial system become less reliable, but insurance can get expensive. When everyone wants protection at the same time, protection becomes expensive. Gold at record prices may still provide diversification, but the price you pay changes your future return. A useful asset can still be a bad trade at the wrong price. Those two ideas can be true at once. A stock is partly valued by what the business may earn, a bond by what the borrower promises to pay, real estate by the rent or usefulness of the property. Gold is different. Its value comes partly from a collective belief that someone else, somewhere, under some future set of circumstances, will still recognize it as valuable. That sounds fragile, but that belief has survived for thousands of years. Gold's strangest strength is the same thing critics call its greatest weakness. It doesn't do anything. It doesn't innovate. It doesn't produce more units because demand rose. It doesn't issue new shares. It doesn't promise 5% interest. It simply exists. And in a financial world made mostly of promises, there are moments when an asset that makes no promise becomes extremely attractive. So why were gold ETF investors selling in the same quarter central banks were buying? Because there was no contradiction. ETF investors were reacting to price, interest rates, the dollar, and opportunity cost. Central banks were managing reserves, crisis risk, and diversification. Same metal, different objective, different time horizon, different definition of success. Gold pays no interest, no dividend, no rent. And after all of this, that's still true. But now the absence of a payment looks slightly different. A gold bar doesn't owe you anything, and you don't need a company, a bank, or a government to make good on a promise for that bar to continue existing. That doesn't make gold automatically safe. It doesn't make today's price cheap, and it certainly doesn't mean every portfolio needs it. But it explains why central banks can keep buying gold at the same moment ordinary investors are asking whether it's already too expensive. They're not buying a machine that produces money. They're buying an asset whose value does not depend on someone else's promise to pay. And sometimes, that is exactly the thing they're trying to own.
Thanks for watching, and I'll see you in the next investigation.